I already own 38 dividend-paying stocks in my personal stock portfolio, but that does not mean that I'm not looking for new opportunities. I am always looking for new dividend-paying stocks out there, and I keep a watch list that I track really closely. Today I want to share with you my personal dividend stock watch list. Today I'm going to share 10 stocks that I do not own right now, but I am actively looking at. I'm actively watching these stocks, and I am evaluating these stocks to determine if they make sense to add to my personal dividend stock portfolio. So stock number one is Kraft Heinz. This is a stock that I have discussed here on my YouTube channel before. I will link in the description below to the video that I did about this company. The reason I am watching this company so closely is they will potentially acquire one of the companies that I own, which is Campbell's Soup. If they acquire that company that I own, most likely, they will do this for a combination of cash and stock, meaning I will become most likely a shareholder in Kraft Heinz if they do purchase Campbell's Soup. So I want to understand more about this company. I want to really understand if this is a company that I want to hold for the long run. When I look at the numbers right now, and I do have some history with this company, by the way, in the description below in the video I already did, you'll learn all about that. Putting that aside, however, with a starting yield of 4.2% at a 5-year low in terms of the stock price right now, and at a PE of about 16, personally, I believe that Kraft Heinz is a bit undervalued right now for the market that we're in terms of dividend growth stocks, in terms of the market being at these really high valuations overall. I think that Kraft Heinz is reasonably undervalued for this market, and so this is a stock I'm actively watching. I probably won't take a position until Kraft Heinz purchases Campbell's Soup, and if they do that, then I will think very hard about keeping my position and probably adding more to it. So that's stock number one. Stock number two on my personal dividend stock watch list right now is J.M. Smucker, ticker symbol SJM. This is a company that makes the Smucker's brand of jellies. They also make Jif peanut butter, a bunch of dog foods, cat foods, all kinds of foods. And J.M. Smucker right now has taken a hit, like most consumer non-cyclical food-oriented stocks. Like Kraft Heinz, for example, the stock is trending down. When a stock trends down, and it's one that tends to raise its dividend over time, it's a company that's done really well over the long run, it tends to make my watch list. And so that's why these types of companies are really high up on my watch list, because they have been doing poorly. And when a company does poorly in terms of the stock price, it tends to present a buying opportunity for a long-term dividend investor like myself. And so with Smucker's, they're yielding 3.05%. That's the starting yield. And their PE ratio right now is a 13. Now, the way I'm calculating PE is I'm looking a little bit forward. I'm looking at the consensus analyst estimate for 2018. So if these guys come in right around the consensus estimate from the analysts who analyze this stock, their PE ratio for this year, for 2018, will come in at 13. 13 for a company like this that raises its dividend over time, that has amazing portfolio of brands, has a reasonably good starting yield, places this really high on my watch list. Now, the reason I haven't taken a position already, if you've been following me, is I already own 38 stocks. I've got a lot of stocks in my portfolio, and a lot of them are in consumer non-cyclical. So do I really need more consumer non-cyclical food stocks in my portfolio? I've already got a lot of representation there, and so I have to be careful if I am to add more stocks to my portfolio. Should they be a consumer non-cyclical, or should it help me diversify elsewhere? Those are things that I am always thinking about when I am watching my watch list. Needless to say, however, this just has to make my watch list because I believe it's an undervalued stock right now, especially at a PE of 13, forward looking for this year. I think it's an undervalued dividend stock in this market, given where the market is at, given where the market overall is at as compared to other stocks out there. I think it's an interesting value, and I look forward to analyzing that one more. Stock number three on my watch list is Dominion Energy. If you've been following my channel for a while, you know that I love utility companies. I like them because they bring current yield into the portfolio. They pay high dividend yields. Oftentimes the dividend is a little bit slower to grow, but they bring the cash forward now. If I need money tomorrow, I need to tap into my dividend income tomorrow, I can always rely on the utilities in my portfolio to provide that current income. Dominion is a regulated electric utility. They're a big diversified utility company. 4.8% starting yield, not bad. And what's real interesting about these guys is actually they aren't that slow to grow the dividend. Their last dividend increase was 8.4% when they increased their dividend. And so I'm not used to seeing that with utilities. For that reason, I like Dominion. I look forward to analyzing it more. I already own some utilities in my portfolio. Do I need more new utilities? Not necessarily, but I like them, and I see some value there. And so whenever I see value, it's got to make my watch list. Next one on the watch list, number 4, PPL Corporation, another utility, another regulated electric utility company. I like this one because it has exposure not only in the United States, but in the UK. If you've been following my channel for a while, you know that I love international exposure. It's really important to me. PPL, man, starting dividend yield of 5.6%. That is fabulous. That is a really fabulous starting yield in this market where the utilities have rebounded a little bit. They're still way down. Whole sector is kind of down, but they started rebounding a little bit. Love that. And they got that UK exposure. So that's a really interesting stock that I'm looking at right now. What goes through my mind, however, is the same thoughts that go through my mind with Dominion. Ian, do you really need another utility in your portfolio? Or should you add more money to the utilities that you already own in your portfolio? Definitely something that always has to be considered when I'm looking at a watch list. Because watch list, it's so tempting just to add more positions to the portfolio. But each position I add has to be very conscious. It has to be very strategic. It has to add some unique element to the portfolio that I don't necessarily have, or it has to vastly mitigate risk. And so I just don't know if PPL is going to do it for me. But that said, this 5.6% starting yield is really enticing. Watch list company number 5. This is one that I have been following for a very long time, probably for, I would say, 15 or more years. It used to be called Great Plains Energy, GXP. They recently merged with Westar. So this was a company, Great Plains was the parent company behind KC Power. KC Power and Westar merged. They have a new entity name called Evergy. EVRG. This company right now is only yielding 2.84%. The merger just happened this year in 2018. Boy, if this merger never happened, I was really getting close to buying myself some Great Plains over the year. I never quite got to it because the starting dividend yield never got where I needed it to be. It was always a little bit too low of a yield, too high of a valuation, because it's a really, really well-managed little utility. Kind of like Hawaiian Electric, which is a company that I own, a utility that I own. And I liked it. We'll see if the merged combined company, what becomes of it, what happens with it. It has to be on my watch list because I've been following Great Plains forever, probably since the real early days when I first started investing in dividend stocks. And so it's one of those interesting ones that sometimes a watch list is not only about current values or about stocks that pop up on my radar because they're a real good buying opportunity, I have a high dividend yield and are undervalued. Sometimes watch list stocks are just stocks I've been following forever, and this is one of them. Great Plains, now Evergy. I've been following this thing forever, so I want to keep following it. I want to see where it goes. Maybe one day I'll own it, but right now with this starting yield in the 2.84% range, that's not going to work for me in a utility sector. Stock number 6, I like this one. So we talked about some consumer non-cyclical. We talked about some utilities. Here's a pharmaceutical company that's on my watch list called Abbvie, ABBV. I know some of you folks out there in the dividend community love this stock, and I like it too. This is a company that used to be part of Abbott Labs. They split the two companies into two separate companies a number of years ago. Abbvie is really the pure play pharma arm now, or pharma business of the two, and starting yield 4.0%. Interestingly enough, their most recent dividend increase is something that was just phenomenal. It was 35%. These guys increased the dividend by 35%. That is just simply amazing. That's amazing for such a mature company. And it was kind of off cycle too. They increased it a bit earlier, I think, than anyone expected. So that's a very positive sign. Forward looking, When one looks at the PE for 2018 with Abbvie, the consensus analyst estimate, the PE is coming in at a 12.19. This is a really good PE for the pharmaceutical sector. Pharmaceutical sector certainly has risks that come with it, such as a drug pipeline, such as a reliance on certain drugs in the portfolio that could have their patent expiring over time. And certainly those are factors to consider. I will probably do a breakout video on Abbvie at some point in the future, but if you've been following my channel, you know that I love pharmaceutical, healthcare sector, medical sector. I think it's important. I think it helps people live longer. I know everyone wants to take good care of their health, and certainly we don't want to take drugs or treatments unnecessarily, but it's companies like Abbvie that are helping people out there live longer lives, combined obviously with good diet, good exercise, all that kind of stuff. And so interestingly enough, a real good value in this market, and I look at Abbvie as an undervalued stock. I already own a few such stocks in my portfolio that are in the healthcare space. My #1 stock of all time, in fact, I'll link in the description below, check that out, is a big healthcare company, a pharmaceutical medical company. That said, there probably is some space in my portfolio for another one. This, if I did add it, would be the 3rd pharmaceutical company that I own. Not too many in that sector. Probably not 100% necessary, but there's this one is quite enticing to me. So watch list stock number 7, Prudential. If you've been following my videos, I don't have any exposure right now into the insurance sector. I have a few banks in my portfolio, so I have exposure to the finance sector. But one of the things that's important to me as a dividend investor is to have representation of most major sectors. And the reason that I want that is when one sector is doing well, another one is doing bad, and they tend to cancel each other out. I am building a portfolio that is destruction proof. I am building a portfolio that if one stock fails, I got another one that picks up the slack. I don't want to worry about disruption of income. I don't want to worry about when I am retired, I'm financially free, I'm living off cash flow from dividends, that anything could go wrong. And so I like having diversification. I like having representation from many sectors, and I don't have insurance right now. So I'm looking at some insurance stocks. The 3 that make it to my watch list actually are these 3. The first one is Prudential. First reason I like Prudential is they sell life insurance. I think life insurance is a really important product. I think it's certainly important for people that have families with kids. The thing I don't like about Prudential as much is the fact that they're really in a lot of financial services type financial planning arena as well. I think a lot of that is starting to get automated and disrupted through these robo-advisors. And so certainly I think there's some risks there for Prudential as well. With a 3.7% starting yield, that's not bad. What I like even better, though, is their most recent dividend increase was 20%. They raised the dividend 20% year over year. That is just fabulous. I love it. And so the PE ratio right now, again, looking this year, looking at the analyst consensus estimate for 2018, comes in at an 8. Off the bat, that may seem really exciting. That being said, the insurance sector tends to trade with really low PEs, so it cannot be compared to these PEs from other sectors. It's just a different kind of sector. Tends to trade with really low PEs. I would say so far out of the insurance companies that I've been analyzing, I like Prudential. I would say what I don't like about it, though, is exposure to like that financial planning part of things, just because, like I said, I think a lot of that will be disrupted. Hopefully they will be the disruptor and they will get into the robo-advisor arena. Time will tell. Watch list stock number 8 is a company called Chubb Limited, ticker symbol CB. This is a property and casualty insurance company mainly focused on the United States, North America region. Interestingly enough, they are based out of Zurich, Switzerland. This company has a 2.19% starting yield and a 12.76 PE. As far as insurance companies go, this is not undervalued. I would say there's stocks on here that are probably undervalued. Like I said, Abbvie is a good one. I'd say another one is Smucker, maybe Kraft Heinz as well. These are some examples of companies that I think right now, given where the market is at, are probably undervalued. Is this company undervalued with a 2.19% starting dividend yield and a PE of 12.76? Not necessarily. That said, this company is known for quality. And certainly if I were to expose myself to the insurance sector, I personally would rather have exposure to products like property and casualty insurance as compared to Prudential, where they do like a lot of financial planning. I certainly like the life insurance side of Prudential, but not as much the financial planning part of things. And so I think the reason Chubb trades at a premium is it's a premium business. And the question becomes, Ian, at some point when you add insurance, do you want to take a little bit of risk and go for the higher yield, the deeper discount, the potential value? Or do you want to just go for quality, which is basically Chubb, which is not on sale right now? Or do I just want to wait, no rush, wait and see if Chubb ever goes on sale? We shall see. Watch list stock number 9 is Aflac, ticker symbol AFL. I've been following this one probably for about 10 years. Totally regret not buying it. This is a company that provides ancillary insurance products, both in the United States and Japan. And this company has a 2.2% starting yield, 11.43 PE. Right now, it is not trading at a discount. There were times in the past where it was. I have watched the stock appreciate considerably over time. I'm kind of at the point where I feel like I missed the train with Aflac. And quite frankly, if I am going to invest in the insurance industry, I probably don't want to invest in this one just because healthcare in the United States, it is in such a state of flux. Anything could happen 10, 20, 30 years out. Anything could happen. And they're not providing pure play health insurance plans, but they're providing ancillary plans that go along with other insurance plans that supplement gaps and such in one's insurance coverage. I just think the landscape is changing too much for having the right visibility with Aflac over the long term. Whereas over the long term, having property and casualty insurance is a no-brainer. Over the long term, having financial planning, even though I don't like it, and life insurance, no-brainer. And so Aflac probably will not end up being an insurance company that I buy. That being said, I respect the company. I've been following it forever. It's got to be on my watch list, and that's why it's there. Number 10 stock on my watch list is AT&T. I will link in the description below. I've done a few video reviews of that stock. I will probably not be buying this stock. It has a 6.2% starting yield, which is just fantastic. Many dividend investors right now love it. And it has a 9.11 PE, again, looking at 2018 analyst consensus estimates. This is just a really interesting value now. I would say in the scheme of things, the stock probably is undervalued. Despite it being undervalued in the current market, there are reasons why I just don't think it's the right fit for my personal portfolio. Doesn't mean that it doesn't work for other people. But why am I watching this thing? I'm watching it just because not all stocks on my watch list have to be stocks that I'm going to buy. Like I said, I've been following Abbvie, which used to be Great Plains, forever, so I got to continue following it. I always liked it. Now it's this new company, I don't know if I like it as much. Same with Aflac. I just see it kind of run away from me. So I don't know if I'm going to buy it, but I got to follow it. But what I'm trying to convey here is it is okay to have stocks on the watch list that are stocks that one may not buy or has no intention of necessarily buying, because it helps you become a better investor. It helps you follow the market, analyze companies, see where things are going. And so a watch list, in my opinion, can be many things. And for me, usually it's stocks that have piqued my interest that I may consider taking a position in. That being said, sometimes I don't have to take a position in those stocks, or I don't even have to consider taking a position in the stocks. I'm just following them to become a better investor and to analyze the companies and learn more about them. So these are my top 10 dividend stocks that I do not own right now, but I'm actively watching. I own 38 stocks, and so adding stock number 39, for me at this point, it's really hard because I don't want to add a lot more stocks. I already have enough stocks, and sometimes I think I should never add another stock. That said, there are corner cases where it makes sense. I just added a stock to my portfolio. I'll link in the description below to that video. I went from 37 stocks to 38. I talk all about that stock. I'll link to it in the description below. But adding 39, I just don't know about that. I'm getting to have a lot of stocks, but I will share in a future video why I have so many, because it's really core to my beliefs as a dividend growth investor. So I'd be curious, which stocks are on your watch list? Are they some of these? Are they other stocks? If you're a dividend investor or even a growth investor, what kind of stocks are you watching right now actively on your watch list? And how do you determine, hey, should I buy a net new stock or add to an existing position? That's always something that I think about every second that I look at net new stocks. Before I leave today, in terms of full disclosure, I own 2 of the companies that I discussed today. I own Campbell Soup, ticker symbol CPB, and Hawaiian Electric, ticker symbol HE, in my personal stock portfolio. I am long on those 2 stocks. Also, in terms of a friendly disclaimer, today's video is not investment advice. I am not a licensed investment advisor. I am just here on YouTube sharing my journey for fun and entertainment, just sharing my personal journey. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Hey, thank you so much for tuning in today. And we are going really strong here on PPC and so if you want to thank me for this video, please subscribe, like, comment. All of that means the world to me. I will see you in the next dividend investing video.